Well, welcome to week 2 of Dollars and Making Sense. Henry, thanks so kindly for joining me again.
Always a pleasure, Ray.
Wonderful. Look, we've had some really interesting feedback. Thanks so kindly for the comments. It's only a small audience at this moment, but we're certainly hoping to build. And again, one of the things that we'll be looking forward to all the time is feedback and questions. So please hit our social links, our websites, and again, there's a nice part on YouTube also where you can comment. I know that YouTube is notorious for some rather interesting sets of comments that I've seen from time to time. But again, we're open to both positive and negative views, and we'll see how we go. So, Henry, the week that was, we had a really fascinating discussion last week with regards to macro events. And again, things don't seem to have progressed all that much. But what's your view and take on aspects of events in the globe that are going to have impact to our local investing environment?
Well, I guess last week we were all about trade and that the tariffs coming in tomorrow in the US, or the increase in tariffs. And on Friday night, we saw what Trump describes as a great deal, a big deal. The Chinese are a little bit more pessimistic, I'd say, a little bit more reality-based in terms of their assessment of this great deal. But there certainly has been a step forward in the trade negotiations. They have agreed to buy more agricultural products, which is not really surprising, seeing as they need to buy agricultural products. They need soybeans. So that is a positive, but it's nothing really new that we've seen out of the US-China talks. But it is positive that they've made some steps, and as a result, Trump has called off the planned increase tomorrow, the 15th of October, on the increase in tariffs. So that is a positive. There's going to be more talks, more detail to come on this, but certainly the markets liked this. They're calling it a mini deal or trade light. Or trade war light.
Trade light, okay.
But the markets have liked this. The US market rallied 300 points on Friday. We saw a 1.3% rise in our market over last week, primarily as this risk about a trade war de-escalates somewhat. So that's caused the bulls to come back. It's caused the gold price to fall slightly, and that has been the one thing that has been under pressure. So the markets are a little bit optimistic about some sort of stimulus, some sort of global growth returning. Couple that with the fact that the Fed is potentially going to cut rates in their October 29th meeting. There is some cause for optimism out there.
But we've seen this before, though, Henry, where with the result of some sort of output out of a discussion, a Trump tweet, all of a sudden the market goes up, the market goes down. So if there's pessimism, gold goes up, and the indexes go down. And if there's optimism, gold goes down, and we have this inverse effect. I mean, is that something that seasoned investors look forward to, or is that something that they're wary of?
I think everyone's wary of Trump's tweets, to be honest. He is mercurial, to say the least. I mean, it could all reverse in the blink of an eye, or 140 characters. But given that he's
280 these days, actually.
280, yeah.
That's right.
I don't think he gets that to 280.
Does he know? No, well, we're not going there.
He doesn't know that many words. But certainly this is a positive step. Given that there's a number of issues that he's facing on the home front as well, this might be the win, if it is a win, that he needs, given the impeachment seems to be gathering a little bit of steam, and we've also seen that criticism over his policy in Syria. It is a good distraction for him to claim a win, and certainly the US economy has been showing signs that it is starting to suffer from these trade tariffs. And it is not just China that pays the tariffs, it is the US consumer as well. We've got a very important season coming up: Thanksgiving, Cyber Monday, whatever they call it.
Yeah, the Black Friday big retail spend. Yeah.
So we're coming into peak retail season for the US consumer, and it would be a very bad look for the tariffs to come in. Equally, the US farmers have been suffering big time, and despite, I think there's $28 billion worth of subsidies been chucked at the farmers, they're still struggling. So this is going to be a welcome relief for that middle America part of things, the flyover states, if you like, which tends to be Trump's.
That's his homeland. They're all red states, very much so.
Red states, so.
And I guess from that perspective, when we bring that back into terminology and I guess impacts for local investors, unless they're actually directly investing, for example, in farm products in the US, or say, potash related type of products. What does that mean to the average ASX investor?
Well, when the US sneezes, our market catches a cold. I mean, the world is driven by the US. We can't get away from that, much as we would like to. The US market does tend to drag world markets wherever it goes. So we are hostage to that. We're also hostage to the US economy because it is the world's biggest economy still.
Most definitely. 40 cents in the dollar or something.
Yeah,
like that.
so it's a big impact for us, and global growth and products being sucked into the US is good for commodity prices as well, and that does help obviously as we export an awful lot of commodities to China that then get made into things that they then sell to the rest of the world. So it does have an impact on us, and also it does have an impact on our currency. We've seen the Aussie dollar strengthen. It's nearly up to 68 cents at the moment. This is as the US dollar weakens. Maybe that we see a little bit less of the Fed. Maybe they don't have to cut quite so aggressively if the economy does turn around a little bit. So it's interesting times as usual with Mr. Trump. And
we've been saying that for 2 years now, haven't we? It's been interesting times.
It has, and it's not going to get any less interesting going into an election. And for us, I guess the crux of it is always we go to bed on a Friday night in Australia, and then over the weekend he can get moody and grumpy on a Sunday night, US time, and then we come in Monday morning and have to be the first ones to try and measure the consequences of some of these tweets, some of these deals, because they happen after US closes.
Yeah, it's an interesting thing that we talked about just when you got back from your trip to Europe. What impact do you think time zones actually has on Australia, given that we're at the front end of the spectrum? So we're here working right now.
Yep.
I'm a big NFL fan, so right now I'm watching football scores. So my beloved 49ers are 5-0, so I'm really happy about that. But the Yanks are still not at work.
No.
So, we are here working and commentating and commenting, yet really nothing's happening yet.
That's true, but money never sleeps. I mean, at the moment, the US futures are still open. So the US futures markets reopens on Sunday night. So we do get some indication.
So you're getting indicators already?
You do get indications about what the US is thinking, or what investors around the world, because investors around the world are hedging and trading in multiple currencies, multiple jurisdictions, multiple time zones. It is a truly global business, and money never sleeps. It has to move around. It has to try and make the most of its opportunities. So we do get those leads in from the US. Sometimes we find that Australia, because we open first thing Monday morning, we're the first market to open. I'm not really counting New Zealand because it's
very small, and I'm glad you raised it.
It's tiny. It's hardly worth.
People talk about it, and again, it's about context. And sometimes, I mean, I've got some very near and dear Kiwi friends, but it's a small market. It's 4 million people. It's the size of Sydney.
Oh, well, their New Zealand Stock Exchange is tiny. I mean, compared to the ASX. And any of the big companies in New Zealand are dual listed. So they're also listed on the Australian Stock Exchange. So, very few people would look at the New Zealand Stock Exchange
and give it any real credence.
But our market is the first one that opens in the kind of the developed world, the big markets, although ours is still a minnow compared to other markets. But it does give you a good idea, because we do have some global proxies in terms of BHP and Rio and those sorts of stocks which are exporting to China. And we also do have a very large financial sector. So that does give you an indication of how people are thinking in terms of bond yields, in terms of finance stocks. So we sometimes we lead the world, other times we follow the world. It just depends on how it's going.
It's an interesting segue that you've mentioned the banks, because I was reading this morning in the missives that the government, our treasurer is now looking at the Hayne Royal Commission and suggesting to the banks that maybe they shouldn't be paying all that much attention now to the findings, and that rather than have the strict regulatory environment that we've been promised, that the axe is sort of falling, or the pendulum is falling, a little bit back towards the personal responsibility element. And I think what he's trying to do is, I guess, unleash the banks to get out there and start lending again. Did you take the same read as I do? Yeah,
I mean, to have a strong banking sector is unfortunately part and parcel of having a strong economy. You need banks to be lending, because that's the grease in the wheels. That's what makes the world go round. So if you have banks that seize up, and exactly. So if you have banks that seize up and stop lending, which is what happened during the GFC, things go downhill very, very quickly. So we've seen that in the Australian economy in the last couple of years, with the housing market just stopped. and we saw falls in house prices in major capital cities, and the banks stopped lending, and they had APRA on their back, they had the ACCC on their back, they had the Hayne Royal Commission on their back. All these people were telling them, naughty boy, you mustn't do this, you mustn't do that. And it was just easier for them to actually stop doing business. The problem is that that's not good for the economy. So that the Treasurer does need, and the government does need, to have a robust, successful, profitable banking sector. It's one of the bedrocks of our Western capitalist system. There is no getting away from that. What we don't need is the banking sector abusing their position of privilege, abusing their banking licenses, and taking advantage of their customers, which is what we've seen in the past. Now, hopefully, they have learnt their lesson, and we can go forward with the banks that are socially responsible, that are happy to lend, but do so under the right criteria and charge the right amount of money, and make sure that they don't abuse that privilege.
But again, I keep thinking about these macro and even sort of semi-macro views here in Australia, and trying to bring them back into the context of our listeners who are local investors, for example. And many of the investors I come across at investors associations, discussion groups, etc., are very heavily represented in the banks, and so they'll be looking very closely. And we talked last week, for example, around interest rates and around NIM. If you can remind the viewers again and listeners about NIM.
NIM is not a fairy from Peter Pan. NIM is net interest margin. It is basically banks take people's money on deposit, they pay them an interest rate, and they lend it out to other people at a higher interest rate. And the net interest margin is their margin, the difference between the deposit rate and effectively the rate they lend money at. So that's very important for banks, because in a world where fees and charges become harder to push on to consumers because of the Royal Commission and other things, that net interest margin is the most important thing. Now, of course, at the moment, we've seen last week, tail end of last week and the beginning of this week, the Treasurer Josh Frydenberg looking at the ACCC to push the banks and inquire into them as why they haven't.
He's just launched another probe today.
Another one. I mean, the banks must be bored sick of this. Every week there's another.
But again, I throw the question back to you as a commentator and as an avid watcher, and I'm scratching my head going, look, they've snubbed their noses at you already. We talked last week specifically about 400 basis points granted from the RBA, but less than 300 being passed through. And so the banks are now making bigger margins on the same loans that they had on their books from 5 or 6 years ago. All of a sudden, the Treasurer comes back and says, well, I'm going to unleash another probe on you. I sometimes get the feeling, is that not whipping the banks with a toothbrush on the back? I'm scratching my head going, what's the darn point?
And there is no real point, apart from it looks good that he's doing something, and it's all about politics. If you look at the bank results themselves, the net interest margin is not, it's around 2.13, 2.12, something like that, maybe on average for the banks in terms of their NIM. The problem they have is as interest rates go down lower and lower and lower, they have to reduce their borrowing, the money they lend out, the borrowing cost to consumers. But it gets harder because you can't go negative. Now, we got 0.75 with the RBA, and to be honest, the RBA has been kind of irrelevant for the last 5 years anyway in terms of the actual pricing.
Well, they certainly don't know how to estimate an inflation rate. They've got that wrong every year.
Well, that's their prerogative, and they're very good at that. They're very good at getting it wrong. The Treasurer and the Treasury departments are also very good at getting forecasts wrong, and economists generally get things wrong.
But again, doesn't that shake investor confidence when the central bank that's supposed to have a lever on everything that's going on can't get the basics right of, well, this is how much we think the economy is going to grow, and this is how much we think money is going to degrade in value. They keep getting it wrong.
Well, that's true, but I think that most investors just look at the bank yield and say, you know what, 5.5% fully franked, where else am I going to get that?
Yeah, it's pretty darn good return, isn't it?
It's pretty impossible. There's obviously stuff out there, but for that level of risk, it's hard to go past the banks, and that's why they're 25-30% of our index, and probably 25 to 30% plus of people's portfolios, because The old days of buying Telstra when you could get your 6% fully franked dividend yield.
Oh, they're long gone.
Those
long
days
gone.
have long gone. So everything else becomes more risky. The banks are solid, and in theory, that their dividend paying potential remains massive part of the attraction.
I mean, Telstra's got an NBN now to sort of bring them back to heel. Do we need an NBN's type of equivalent in the banking sector?
Well, maybe. We've got a lot of fintechs growing up, a lot of neobanks coming out, and we've got one listing very shortly, Latitude Financial.
Okay, and what's the ticker on that?
LFS is the ticker, but it doesn't trade yet. Won't be trading for another week or so. But Latitude Financial, this is really GE money. This is repackaged.
That's the old GE Financial Services, yes.
Yeah, GE Financial Services. So they put lipstick on the pig, dressed it up, and they're going to be floating it off with a high-profile CEO in place. So.
And Alec Baldwin, I think, is their ambassador on telly.
He used to do all the adverts on TV.
Yeah, but again, they don't come cheap, those guys. They cost a lot of money. So when I see them doing that kind of advertising, and there are a few wholesale trusts out there that I compete against, and full page ads in News Corp, and they're lashing out money and getting Alan Jones and 3AW and Switzer to be touting their products. I'm scratching my head going, wow, and a lot of people turn up to these things. And those marketing costs all have to be paid for, don't they?
They do. And, there's kind of a golden rule that I have in IPOs and companies coming to the market. The glossier the brochure, the more you've got to look at it in serious detail, because usually they're trying to hide something. And the classic was Maya with Jennifer Hawkins. Pictures of Jennifer Hawkins all over the prospectus, and if you bought shares, you were basically going to have dinner with Jennifer Hawkins. It didn't turn out that way, and of course Maya has been a basket case ever since it listed.
Well, Jennifer Hawkins actually lives just around the corner here from us in Carril Bay, and so it's a darn nice house. So I'm hoping that she and her husband have done well from the advertising. But for the poor old shareholders who fell out of bed next morning, again, it's just one of those things, investors and viewers. I always try and it's a competitive marketplace, and you've got to be out there in marketing and advertising. No one disputes that. But I think Henry, maybe we'll put that up as one of Henry's gems. The glossier the brochure, the warier you need to be, because it's certainly one of the things that really I get, my hackles raise and my antennae really start coming up when I see really high-priced ambassadors or glossies that go well beyond. And you look at the yields of some of these and you're scratching your head going, so you're offering 3.5 points on money, and yet you've got these events going here, there, and everywhere. And I beg investors sometimes, don't be lulled by this. But a fool and their money are soon parted.
But it's all about marketing. Financial services is all about marketing. You turn on the telly at any time, and there's the people with the
industry super guys.
The industry super guys. It's all about marketing. It's all about the superstars of finance. The Hamish Douglases.
It's Magellen, isn't it? Hamish.
Magellen, Kern Nielsen from Platinum Asset Management from years ago. It is all about marketing and getting your message out there and cutting through, because there's a lot of competition out there.
Yeah, I mean, your own boss, Marcus Padley.
Yep.
I mean, he, the thing that I always notice about Marcus is he's provocative, and so from that perspective, he gets noticed. Sometimes for wrong reasons, but a lot of the times for the right reasons. And I mean, I always remember one of my units at university, marketing units, was it doesn't matter what they write about me as long as they get my name right. Spell the name right.
Yeah, and you look at
S-A-N, by the way, S-A-N.
You look at financial stuff, and there every day you get an email from somebody saying, the end of the world is nigh.
Of course.
The financial system is broken. Watch this video and it will protect your family from the growing downturn, and you can be a prepper. All this sort of stuff's out there. Equally, you can get the same emails from people saying the market's just about to take off. Cannabis stocks are the best in the world. A little known mining stock is going to quadruple overnight. It's all about trying to get noticed, and in a world of grey, middle-aged, balding people, that is what it's all about. It is about getting noticed, and whether that comes from making provocative statements. There's a relatively well-known economist here, Gerald Minack, who used to predict the end of the world. You know, every time, and I saw him present recently at I think it was an AIA thing, and once again it was going to be the end of the world. I mean, the fact that the presentation, he had given that presentation 4 months beforehand, you know, that's, you know, you could be hanging on a long time for the end of the world.
But I mean, you know, in this world, the internet world now, where you know, I remember the old saying, "Today's newspapers, tomorrow's fish and chip shop wrapper." I mean, the news cycle is even faster now, and so something was said 4 months ago is truly ancient history these days.
It is, unless you keep banging on the same message.
Or you have a good search engine as well that can go back and look.
Yeah.
Okay, so let's roll on. And so now we're at this point in the program where we roll into our weekly regular spot, which is buy, hold and sell. So let's kick off with buy. Henry.
Buy. This is an interesting one. I actually came out with some numbers today which I thought were quite good, and it's a stock called Praemium. Some listeners and viewers may be already familiar with this one because it...
And how do you spell that?
Praemium. The code is PPS.
PPS.
And it is basically an SMF, a kind of platform provider. So it has funds under management, it has a business in Australia, which we actually use their products here to run our separately managed account business that we have in Melbourne. So it is a product that we're familiar with, and I have to say it's probably not the best product in the world from a user point of view. But having said that, the stock has suffered in the last year or so. It's got a big UK business,
right?
And because of the Brexit uncertainty that we've seen, that has really suffered because of regulatory and approvals and those sorts of things that have been happening in the UK. But it does look as if it's starting to turn the corner. I think it bottomed at around 35 cents. It's got up to around 52 cents today on the back of its funds under management report, which did show some pretty solid growth. So that's the key with these sort of companies, these platform providers of some sort of financial services, is that how much money they've got on their platform.
FUM is what it's all about. FUM, funds under management.
That's right. Girls just want to have fun. So that is the important thing for these guys, and it is starting to grow. And the big kicker for them, of course, would be if there was some sort of certainty, some sort of deal with Brexit, because they do have a big UK business. So for me, it's one that's just turning the corner. It has gearing towards an improving equity market, because even if they don't get new money in, the fact that the old money grows by 1% and 2% because the market grows is also important as well, because they get fees on the back of that. So that's certainly one that I'm quite keen on keeping an eye on.
Okay, and with that particular stock, will it benefit from Brexit deal being done or being extended out and waiting more time?
It just benefits from certainty. So if we do get the worst thing that business can have is uncertainty, because that just puts you into paralysis. You don't do anything.
But the weekend events, Boris Johnson, it looks like they're not going to be able to get a deal.
Well, the weekend event, on Friday, certainly the Irish Prime Minister and Johnson seem to be more positive about the deal.
But again, certain things happened over the last 24 hours, in fact, where the Europeans are now saying, guys, don't hold your breath.
Well, they're always going to say that. What I'm saying is that if there is some kind of deal, even if they fall out of the EU badly with a hard Brexit, at least everyone knows
what's going to happen.
So then you can plan. It's the uncertainty that really kills business. So if they do leave on October the 31st, whether it's a hard Brexit or a soft Brexit or a deal done, whatever the circumstances, at least they can plan going forward, and that does give you some good exposure to that UK economy. We've seen Clydesdale Bank, which is a similar kind of exposure.
It's a big UK bank.
It was up 10% today. Yeah. It had a big run on Friday.
I'm just curious though, are the markets pricing in any element of civil disobedience by Boris Johnson just by ignoring the Ben Act and saying, no, bugger it, I'm just going to do my own thing anyway?
I think the markets are well and truly over it, to be quite honest. I think the population of the UK is well and truly over it. They just want it settled. They just want it sorted, and they will probably cut Boris some slack in getting it sorted. What would be the worst scenario is if they pushed it out to January, we had a general election, and it just dragged on and on and on, and we'd have the winter of discontent. That would probably do or don't. Just
Get
on with it.
Get off the pot or
get on with it.
Poo. Yep, fair enough. Okay, so that's a buy at Praemium.
Yep.
PPS.AX is the ticker. Any other buys that our investors and listeners should be listening out for?
Well, there's an awful lot of stocks that have got the benefit of being geared to a brightening economic cycle, and if we do see the global economy stabilise, I think it's, we've still got tariffs in place, we've still got a trade war, so it's unlikely that we're going to see a global synchronised growth spurt again,
right?
But we might just see some stability return, in which case you look at even banks should do okay in that scenario, especially the BHPs, the Rios of this world. That may help in terms of a recovering China, that will drag the prices there up. So, and we've also got things happening in the oil market as well. So the oil price has crept up. There's been some issues in the Middle East again with an Iranian tanker and those sorts of things, keeping things bubbling away. And Saudi Arabia, in theory, is going to be doing the biggest IPO in the
Aramco, isn't it?
Aramco, which has been on again, off again for the last 2 years. And you would imagine that if you want to float 5% of your biggest asset, which is Aramco, the Saudis are not going to let the oil price crater during that process.
No.
They're going to massage it to ensure that it's relatively stable.
Again, do you have it off the top of your head? And sorry for a question without notice, but Aramco, if you brought it into an Australian setting, what kind of market cap would it have at IPO, at listing in context of an Australian market, for example?
Probably bigger than the whole Australian market.
That's what I thought. It's pretty darn big, isn't it?
It's massive.
It's absolutely massive.
It's massive. It will be the world's... assuming they sell 5%, then you value the rest of it on the back of it.
Yes.
It's going to be hard for people that run indices to manage it because
you put it in there and all of a sudden it totally outweighs everything else.
And also with only 5% of the stock available to trade, the liquidity is going to be a bit of an issue.
Good point.
But it is
Good
big,
point.
and it's going to be the biggest company in the world, bigger than Apple, which currently is the biggest company in the world.
Wow. Okay, so we'll keep an eye on that.
Yeah.
Okay, so any other buys?
I think just the market generally feels as if it's got a more positive tone. We're heading into US reporting season, which I think everyone knows is going to be somewhat disappointing, but that is going to be a backward look rather than a forward look. The key will be the outlook statements from the US corporates, and we're also heading into our own AGM season, and the same applies. It's going to be all about the outlook statements from the CEOs, how they feel about the economy going forward. At the moment, you'd have to say our economy is stuck in, I wouldn't even say first. It's not even in first gear. It's crawling at the moment. The only bright spot, if you like, is the housing market, which has recovered substantially, mainly on investor housing. And maybe that's because they're too worried about equities.
But it's still off a low base, though, that housing, wouldn't you suggest?
It's coming off a low base.
Yeah.
But, that is the bedrock of everyone feeling good. If their house is worth more,
absolutely,
they feel good,
and
they spend
sentiment,
more.
We should never, ever ignore sentiment.
No. The problem is, when you look around the economy at the moment, and it is really stuck. We have a government that is absolutely obsessed with a surplus, rightly or wrongly, and I think wrongly because we've got record low interest rates. They should be out there spending and stimulating.
Borrowing at 1%, what's the big deal?
Yeah, even Greece issued a debt instrument last week at a negative yield. That's Greece.
That's brave, isn't it?
Not only brave, they got $500 million through the door.
That's
US.
That's astounding when you think about it. That's astounding.
People talk about irrational exuberance in the equity market. I think they're completely missing the point. The irrational exuberance is actually not in equities. The irrational exuberance is in the bond market.
Oh, I couldn't agree more. I was actually at the the DY Independent Retirees Association today, and just doing an introduction to bonds 1.01. And again, 3 or 4 of their questions were, why are there negative yields out there? And maybe, I have my take. What's your take on it, Henry?
There's just too much money. There's too much money. There's too much money in the world chasing too few opportunities, and they just want some sort of safety. 17 trillion US of negative yielding bonds. A lot of it is Japanese, but there's too much money in the world. The central banks have printed too much money, and the world is awash with it's perverse, but the world is awash with debt, but it's also awash with a lot of money looking for somewhere to go.
Somewhere to go.
And unfortunately, when you're a big pension fund or you're a big sovereign investor, you cannot put it into BHP. You cannot put it into Computershare. You cannot buy.
There are only certain things they're allowed to put their money into.
And if you're a big insurance company, QBE or IAG, you have to put money in US Treasuries. You have to put money in things that are safe, tradable very quickly, so if there's a major event,
liquidity, yes, absolutely,
they need the liquidity to enable them to pay out. So there's too much money chasing too few targets. That's the big problem.
Okay, so moving on to sell.
Well, I guess this feeds into the same theme. We've seen interest rates around the globe being pushed down and down and down, and as a result, what they call bond proxies, which are stocks that do well out of low interest rates, have been doing extraordinarily well. Things like Transurban, Sydney Airport, AIA, which is the Auckland International Airport. These sorts of things, APA, which is a gas pipeline business, these sorts of companies have done very well in terms of their share price appreciation because interest rates are getting lower and lower and lower.
And so more money's flowing into equities.
Well, more money's flowing into it makes it easier for them to borrow money and to refinance the existing money at ever lower,
because the bonds
rates
are out there that are cheap. Corporate bonds are cheap.
And these guys, if you're building a road or you're running a road, you've got to borrow a lot of money over a long time frame, and you kind of front load the income comes in bit by bit. Your $4 when it goes beep as you go past the toll road. That comes in gradually, but the debt is sitting out there.
The debt's always there
in 30 years' time. So lower rates do really help their business. So I think if we do see the bond market correct, and I had a really good chart in the newsletter this morning of the money that's going into bonds or has gone into bonds.
This is the Markets Today newsletter that you write for.
It's gone up like that. At the same time, equities investment has gone down like that. So we're seeing lots of money going into bonds and not so much money, and actually money coming out of equities.
So that's looking for safety then.
So that's looking for safety in a risky world. Now, the markets are really momentum driven these days. If we saw that flip round and start to move back to what is more normal, that could have big implications for interest rates. We could see interest rates actually rise, and we could see equities, perversely, which have done well out of low interest rates, rise as well, because as that money comes in. So for me, I think you've just got to be a little bit careful. Even last week we saw some numbers out of Transurban in terms of their traffic growth, and you could see there the effects of the slowdown in the local economy. And it's not just about cars that are travelling on their toll roads. It is about the trucks, because at the end of the day, cars pay $5.50 or whatever it is.
So let me go back. So you're saying that Transurban right now is a sell?
I think there's some money to come out of bond proxies, yeah.
Okay, and same with Sydney Airport?
I don't think they're a massive sell. I don't think they're going to go, into a heap, but because the market will rise a little bit. But I think if you're looking for outperformance or underperformance, if I was a Transurban shareholder, it's hard to see what's going to make it really sexy in the next 6 months, and suspect that we may see the stock price, gradually, and Sydney Airports and those sorts of stocks, the APAs, gradually sort of, as people get more comfortable with risk and less defensive about their asset allocation, we may see some of this change, and we may see these bond proxies slip, and we may see more risk assets, the things like BHPs, the Rios, the Fortescues, those sorts of things, the Woodsides, even today Santos, good result today from Santos. We may see some of those risk assets in resources, and maybe even the banks start to move higher as people get less defensive on their investments and look for growth.
Okay, so in the wrap up, are there any other companies this week that do you think our listeners and investors should be looking at?
The one that I think is interesting, and we talked about it this morning, if you do believe that this is phase one of a much larger deal, depending on your time frame, certainly stocks like Magellen, which we've talked about earlier, MFG is the stock code there, it is kind of double geared, because it has gearing because it's the fund manager, so it makes more money as they get more money under management. As the market rises, if it rises, that money grows, also because they suck in more money as well, because their performance figures improve. So it's been sold off recently. It did get quite expensive, so I think that's got potential to bounce back. Also looking at, for the same reason, the ASX as well. It is a platform stock. We just saw a a big bid for the London Stock Exchange. The Hong Kong Stock Exchange made a bid for them. That didn't go ahead. The Hong Kong Stock Exchange couldn't get enough interest from the LSE. But ASX is a big regional platform. I wouldn't be surprised if Hong Kong had a little look and went, you know what? Maybe if we can't buy London, let's concentrate in our own backyard.
No, fair enough.
And look at ASX.
Okay.
And also, it does benefit from higher volumes, more optimism around the market. We've seen Latitude Financial, which we talked about earlier, which is the biggest IPO this year, will come to the market. If that succeeds, there will be a string of Latitude lookalikes that will then join the procession to the market, and the ASX does very well out of new IPOs.
Okay, so let's wrap it up for this week now, Henry. Thanks so kindly for your take on buy, sell, and hold. So for listeners and viewers, we'll be putting all of those company details and their tickers and links on our website, our blog, and our YouTube commentary. Again, what I like to do is just put the little time marks there so you can jump ahead if you don't want to listen to it all. That's perfectly fine. So at this stage, we'll wrap up for this week, and this is the week commencing the 14th of October. We look forward to your feedback, your comments, and Henry, again, we'll see you next week.
Great. Thanks, Ray.
All the best.